Good evening, friends. Thanks for joining this call to discuss global outlook and opportunities. Hope you all are fine and doing well. COVID cases are rising, so this is required. Now, coming to this call, I have with me my colleague Ram Kumar, who is a co-host for this call, will be moderating this call with me. And we have a special guest, Mr. Ashish Jain from Suisse Asset Management, based out of Singapore. Speaking about uh, Ashish is an IIM Bangalore student, training by IIM Bangalore, and then has moved to Suisse AMC, and currently based out of Singapore, and he's responsible for delivering products and solutions for institutional and private bank clients for Credit Suisse in Asia, ex Japan. He also specializes in alternative investment solutions. And prior to this assignment, he also was fund manager for emerging markets. So he carries vast experience as far as the regional markets or emerging markets is concerned, but has been part of Credit Suisse for a long period of time. And as you know, that or you may be aware that in last September, we had launched our first international offering, Developed World Fund of Fund Indexes Fund, uh, in alliances with Credit Suisse. So Credit Suisse is our partner in the offering. Uh, uh, we had a good start, but as you all know, that around February, SEBI and RBI put together had put an embargo or stopped further flows into the overseas funds. So accordingly, we also had to stop. And recently, now subject to certain conditions and caveats, they've again allowed funds to restart uh, the fresh purchases in the international offerings or overseas offerings. And therefore, we thought it was a good time to again connect with you people to discuss the prospects for the fund. But before that, I just thought, let me set the background for this call. And as you know, that since the our offering in September, many waters have flown, and particularly this CY calendar year 2022 has been really challenging on various fronts. So what are we seeing this year? So couple of things for you, couple of slides that I just can run through, set the background. As we all know that the key event for this year has been the Russian-Ukraine crisis, geopolitical crisis, and that has changed many dynamics in the world order. And you can see the commodity prices have spiraled, be it oil or even on the food side. You can see even the wheat prices globally have moved up. And once you have this kind of impact, commodity prices going up, logical to follow that inflation also starts spiraling. And we also know that when 2020 pandemic started, there was a lot of loose monetary policies, fiscal stimulus provided by various governments, and there was easy liquidity policy. All put together, we are actually seeing from a negative or a near zero zone, the inflations have spiraled globally across geographies. And to control that inflation, the logical fallout is to raise interest rate also. So it's India also we have raised, but it's the global phenomena where rates have started moving on northwards in every part of the world, except I think Japan. And back in India, we know that Indian rupee is now across 79. It's all-time low for Indian economy, for Indian currency. We all keep debating, but India is not alone in this saga. You can see against US dollar, because when US interest rates are rising, almost all the countries currency have also depreciated, and we, in order to remain competitive, we also need to adjust our currency accordingly. Our biggest competitor remains that China, which also has depreciated significantly, so we need to also adjust. And similarly for other BRICS country also. Only exception here is the Russian economy, because of its various policy end up, it looks something different. But you can see largely all developed nations, Euro, Japan, even Turkey, an emerging side, everything has sort of depreciated vis-a-vis dollar. And the fallout of all this turmoil that is going on in the world market is the impact on the stock market. And you can see MSCI World, our fund which tracks MSCI World, has fallen 19% this year, but the Nasdaq has gone down by nearly 28%, S&P 500, and every component in the world market. So it's not only about the developed world, even emerging markets are down. Japan is down, Canada, Ashish Jain, who can throw some light on what they feel is the current global scenario, what are their thoughts on this thing, and where is the opportunity line. So I just thought that we set the background for this call, and then for without much ado, I now invite Ashish. Ashish on the call is our distributors and investors who would like to hear your thoughts, views on the global market outlook, and of course the way forward. So with this, over to you, Ashish.
Thank you very much, Ashok and Ram. Really appreciate the time and the opportunity to speak to your distributors and your team. And thanks all of them for taking the time to hear me today. So it's been, I think it's fair to say that it has been a challenging year so far in the financial markets. High inflation, which has led to increasingly hawkish central banks, and the war in Ukraine has given investors plenty to worry about. Now, as a result, equity markets are sharply lower. They're markedly below the previous highs. And on the other hand, government bond yields are up substantially. So from a global market perspective, generally equities and bonds tend to balance each other. One acts as a hedge to the other allocation, but this is one of the years where both equities and bonds have lost money together. I think I will get into some of the details, but I'll just say some of the key messages up front and then elaborate more of them. The first one that we think is that inflation is close to peaking, very likely in Q3, calendar year Q3 is the expectation for the inflation to peak. And as the economic momentum globally becomes softer, it is likely that bond yields, start to decline after that. That's, I would say, the first point on inflation and yields. The second, I would say, is for global equities, we really think that this is still the time to retain an overweight position. The reason being, we think the recession risk remains quite low in the next 12 months, even though the global growth will moderate from the last few years' strong pace. The third is we are also quite mindful of the fragile state of the financial markets, the nervousness that we see, and definitely emphasize the importance of risk management, diversification, and more long-term approach to investing. Now, with those key messages, I will now elaborate a few more points. First, on the GDP growth expectations, I think that's a key number that a lot of people are focused on, and rightfully so. I think this year, the GDP growth expectation is 3.2%, and the next year, we expect it to be lower, but still growing at a reasonable 2.7% in 2023. Now, while there is some possibilities of a recession, that is not our expectation. The other part is, as the real incomes are getting squeezed by inflation, financial conditions are tougher as the central banks have been tightening monetary policy, or have been talking about tightening policy. The financial conditions are tougher globally, maybe except Japan. And there is falling business confidence in many parts of the world. So these are certainly headwinds or challenges in the quarters ahead. And that is one of the reasons that we expect the growth going forward to be slightly lower than what it has been in the more recent times. Now, with that, we also expect on the positive side that there is some rebound expected on the industrial production side, especially as China, which has been following a very strict COVID zero policy, is now opening up. So that is likely to soften the blow, and might lead to a small rebound even in the next quarter or two, and then towards later in the year it probably normalizes. I think that's on the growth side, that still expected to grow this year and next year, but next year to be a bit slower than this year. On the the second part, which is really on top of many minds, and central banks really have been a big influence in the market this year, be it the Fed, which of course has the biggest impact, but also the European Central Bank, the Bank of England, have been quite vocal. Ashok mentioned about the central bank, the Reserve Bank of India as well. They've all been hawkish, as inflation remains significantly above most central bank targets in major economies. At US and Europe, it's even above 8% at times. Now, along with that, it has also been sticky. So as energy prices are higher and supply chain issues from China have continued, the inflation has proven to be more stickier than other central banks have expected in the past, and now they are reacting to it. On the supply chain side, one of the risks that exist is, so far the disruption has been more limited to Asia from China, but not so much in the developed economies. In fact, if you look at the data, the developed economy side supply chain issues were much more last year, but they have consistently continued to improve this year, and that's been a positive. So what do we expect from central banks in the near term? I think they remain firmly in the tightening mode. So they are very likely to remain hawkish in the foreseeable future. Just from the US Fed, probably another 200 basis points of hike is expected, and it could bring the rates up to 3.5% or slightly higher. The European Central Bank, even though not as high as the Fed, probably raises rates to 1% by the end of the year, and even 2% by next year. So from the currently negative interest rate, Europe is moving into the positive interest rate territory. Bank of England is also hiking. I think Japan remains the main exception, and probably will remain that exception for this and next year in terms of avoiding tightening in the monetary conditions. I think with that very active approach of the central banks, our view is that the inflation is likely to peak in Q3. So, in the July to September quarter of this year. So within the next 2 to 3 months, we think the inflation is likely to look like coming down. It won't become very low, but it should come down from the highs that we have seen. And only when that is seen, that inflation is actually coming down, is when the central banks are likely to start being less hawkish. So if you speak about peak inflation, that's likely to be Q3. And because of that, the peak hawkishness of the central banks happens in Q4. This is our view. Now, the other way to look at it is, as everybody is expecting the global growth slow down, as I mentioned earlier, the growth to be there, but less than this year, that also helps to moderate inflation expectations. You cannot have a slowing growth rate with a very high inflation expectation. That's not normal. And it is also seen in the market that the inflation expectations are now coming down in the last 1 to 2 months. So there is a break-even rate that you can monitor in the markets, which is the inflation expectation over the next 10 years. It had gone up to 3%, which is very high compared to, it was below 1% in the early 2020. It went up to 3%, but it is now coming down in the 2.5% territory within the last 6 to 8 weeks. So market is now expecting at least the inflation to not be as high as they were expecting it 2 months ago. And I think that is also a function of how active in communicating and in acting the central banks have been over the last few weeks. Now, I think this combination, that central banks are hawkish and tightening policy, but on the other side, the growth is reducing. It's not a very common situation. And we think one of the reasons that is driving our lower growth forecast is because of that combination, and that can cause a period of slightly lower growth. I think on oil prices also have an impact on the income people have and the spending ability that they have. But in context of the GDP, when we compare the consumption of oil, how much impact it is having on people, it is higher than the last couple of years, but it is not as high impact as it used to be in the previous times when oil prices were high. So it is having an impact, but not as much as in the past. So I think so far, and most participants might see that I've painted a bit of a gloomy picture with a mediocre outlook so far. So maybe I'll shift gears a bit and talk a bit about what is on the positive side. I think the biggest factor that is positive today is the consumer. I think as you might experience it in India as well, but in many of the developed countries, US or Canada, and including Europe and UK and other economies, I think there is a very strong statistic that the household net worth, in Canada, in the US, so North America, which is still the largest economies in the world, the household net worth has increased by 80%, 80%. The household net worth has increased for people in US and Canada since the end of 2019. So 80% jump in household wealth from end of 2019 to now. It is financial assets, non-financial assets, other things, reducing leverage, but overall the net worth has massively increased by 80%. The second is, even in Europe and in the UK, this has increased by 20 to 30%. So people are much more wealthier today on average, the household, than they were about 2 years ago. So part of the reason for that is the household savings rate of the consumer spiked massively. So people were saving 4 to 5 times what they used to save during the COVID years in the US and the UK. And in Europe, this number was 2 times. So the savings rate, which has historically been quite low in the US and UK, really spiked in these 2 COVID years. And in Europe, which is somewhere in between US and, let's say, an emerging market like India, even there the savings rate went 2x. So today the consumer is very strong. The consumer can still support the economy to a strong extent, and these are economies, the developed markets uh, are where consumption, the consumer by far is the biggest driver of the economy. So even though some of the non-discretionary spending like food or energy or rentals or even the debt servicing, paying interest on your on loan that you may have, that has become a higher portion of your disposable income, but the absolute level of wealth has been much higher, and wages have also been going up over the years. So I think all of that means the positive side is the consumer remains very strong. Now, what what it means in terms of investments, and I'll come to that slowly, is that even though GDP looks like to be slower growth than before, and some of the cyclical parts of the economy might face a higher challenge, overall the economy remains very strong because consumer is by far the biggest part of the economy, and some of the consumer oriented areas remain much better. The other thing which is also supporting this is labor demand remains very high, unemployment remains quite low, the wage growth remains quite high, and 4% may not look like a high number in India, but wage growth of over 4% over the last few quarters is quite high for US or Europe. And even going forward, it looks like it will continue to grow by over 3%. That's, all of that is extremely positive for the consumer, even taking into account the various, challenges that are being faced. The other side is companies, the corporate balance sheets, again, are very healthy. If you look at distress or which companies are getting into trouble, we are at historical lows on the companies that may be in any shape or form of trouble today. So the company balance sheets are very strong. And if you look at how they are behaving, it is much more consistent with a low growth environment than a recession. In terms of borrowing ability to manage their debt, most companies have refinanced themselves over and do not have debt coming due over the next few years. Fixed rate borrowing is common so that you're not paying more interest. So overall, company fundamentals from a balance sheet perspective remains strong. Why is that important? That when company balance sheets are strong and consumer is still strong, that leads to a better investment cycle. So the sentiment on investment, even if it's a bit less than before, it still continues to invest, which is a positive. I think the third part of what I think is still a positive and helping the market is that the recovery from the big slowdown of the pandemic, a big part of it is done, but some parts are still in the recovery process. For example, consumer, as I was mentioning, is a big part of the GDP. They're 45% of the GDP in some of these developed markets. They are still below the trend spending before the pandemic and continues to recover. So the consumer spending on services continues to grow even on some of the other parts might be slowing. Now, the other reason is many of the cautious people in the last 2 years of COVID are only starting some in-person activities now. Going back to the office is only starting now. So there's a lot of pent-up demand for discretionary spending like leisure, like travel. Many medical procedures were postponed during the pandemic. They are coming back now as people start to spend. So some of these high quality sectors like leisure, travel, medical services, healthcare are continuing to see strong demand. The other is part of the recovery is the supply chain easing. Most developed world is seeing an easing of supply chain bottlenecks uh, as we move out of these lockdown situations in most parts of the world, and that is helping the GDP. So one of the most obvious cases for that is autos, car manufacturing. Unit sales have been limited since the start of the pandemic because production could not happen. Now, after a couple of years of supply shortages and production disruptions, now finally that is easing. And we think that businesses and households will buy as many cars as will be manufactured for the foreseeable future. So, the capital equipment construction side is going to help sectors like these also continue uh, supporting the GDP growth despite some of the challenges shown. Now, I think one of the other parts is the surging commodity prices. I think normally high commodity prices drive some kind of challenge to growth. But what has happened is, if you look at the energy sector, US has a big, very resilient energy sector, a large domestic energy sector. Now, for the last few years, the investments in the energy sector were lagging as oil prices were low, pandemic recovery, and businesses did not have as much confidence during the recovery side. And now we think that the investment in that area is being boosted. New production is coming online. So, that leads to a cycle of investment and growth, which is a silver lining on the high commodity prices. So I think, these areas, strong consumer, strong corporate balance sheets, and these tailwinds from the recovery that are continuing are helping a lot of the developed countries, and many of these sectors are being supported by these. I think I will maybe talk about the equity market now. A few key metrics there, and then we can open up for Q&A. So on the equity side, as Ashok had shown a couple of slides earlier, while the last couple of weeks have seen a recovery or a short rebound, I should call it, the global equities remain significantly below their earlier highs. So MSCI World is down about 20% this calendar year so far. It's the same as S&P, which is down 20%. NASDAQ, which is comprised of growth companies, is down 30%. So if you put that into context, the year-to-date, the calendar year-to-date performance of the S&P 500 index, the US S&P 500 index, is the worst start to the year in more than 50 years. So, we had data since 1966 to track the performance of S&P 500 on a year-to-date basis. And as of the end of June, this is the worst first 6 months for the S&P 500 in over 50 years. So, I talked about a lot on what are the challenges, but I think what it also means is markets have really captured most of those negatives and have really declined sharply over the last 6 months to create very attractive, interesting opportunities. Now, if we look at contrarian indicators, that capture market sentiment, they are close to their lows. So the bearish sentiment, the negative sentiment is really, really strong. Even short-term technical analysis or positioning might suggest there may be some relief uh, rally in the short term. But I think more importantly, from our perspective, the investment committee at Credit Suisse maintains the view that the risk of a global recession or a US recession in the next 12 months is quite low. But on the other hand, the equity markets are actually pricing in almost with a certainty that there will be a recession. Why do I say that? If you look at how much the equity market declines when a recession has actually happened, the top to bottom decline in the S&P 500, the median of such declines in the past is 23%. And we have almost hit that number. When there is no recession ahead, normally the top to bottom decline, the median of that decline is only about 12%. So we have far exceeded the median decline in a non-recessionary environment, which clearly says that the market is already, in my view, pricing in a recession. And the interesting part is earnings, on the other hand, at corporates have continued to grow, including this year. So earnings continue to grow while valuations have corrected sharply. So if we look at P ratio for the broad indices, they are down about 30%. So valuations have contracted by 30% when the price has fallen by 20. And the reason is earnings have actually grown by 10%. So not just that you have seen a price correction, you have seen an even stronger valuation correction in the global equity markets. So, with that, we think the industrial production will bounce in the next few months as China comes online. The corporate balance sheets remain strong. Households are much healthier, have money to support, and they will continue to support the US, European, and other developed market economies. China, as our view has been over time, in the last 3 to 6 months, we were expecting policy to be supportive of China. And while that's not directly, supporting the developed markets funds, if they do it in China, I think the key is as China opens up, it will do two things. That supply chain confidence in the market should come back when China normalizes. So I think that's really, I would say, our view that a lot of these negatives are there, but markets are really pricing in a very gloomy scenario, particularly the equity markets. And I think therein lies an opportunity for a long-term investor to find a good kind of entry point into a diversified portfolio of high quality global companies. Diversify your exposure from an Indian the Indian market, and benefit from diversified across countries, across sectors exposure by looking at some of these opportunities that HDFC is able to bring to you. So maybe with that, I will pause here.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.